Okay, so now we're going to work through the review of the journal entries. Before we go into the specific line items, we'll have to make a general commentary. So if I show you over here, okay, so they are preparing journal entries. That is basically at acquisition journal entries. That's what they're trying to do. So they are trying to prepare at acquisition journal entries, but um, we need to also state something obvious, right? So what's important to take note: the at acquisition journal entries and the current year journal entries. So remember what are we used to when it comes to accounting? We used to doing at acquisition journal entries, and we used to doing since acquisition journal entries, and we used to doing current year journal entries. Now, what's applicable for this scenario would be at acquisition and current year, because there's no since acquisition, because we acquired we acquired Big Ranch in the current financial year. However, these journal entries um, are only correct if our starting point includes 100% of Big Ranch. So what we would have to state at the beginning is to say that we'll have to say that to follow this process of these journal entries, we'd have to start off with the information or the trial balances of um, of Big Ranch at 31 October 2022 as is, and then make the necessary journal entries. Okay, so that's very important to take note, because at this point they didn't do anything. Okay, so Big Raj is just completely excluded. So we would have to say that when we prepare the group consolidated statements, the approach would be to include 100% of the trial balances of Fudjan and of Big Ranch on a line-by-line basis at 31 October 2022. Then we'll process the following journals. Okay, so that is basically what we want to state. So what we're going to say, so in order to process the journals as per um, the document attached, Fudjan need to would need to do the following, perform the following. Okay, what do they have to do? Obtain the trial balance of Big Ranch at 31 October 2022. Okay, add it to the trial balance of Fudjan at 31 October 2022. Okay, so what is this? This provides starting point required to make the necessary. This provides the correct starting point required to make the necessary pro forma journal entries that will end up with the correct consolidated Fs. Okay, so remember, the whole process of consolidation is to understand the starting point and understand the end point. So the end point is the group financial statements. So the end point is the group financial statements, right? 100% of the parent, 100% of the subsidiary on a line-by-line basis, and then eliminating any group adjustments. Okay, so group adjustments would be either adjustments relating to fair value adjustments at acquisition, or group adjustments would be any intercompany transactions. Okay, so that is basically what we want. So the endpoint is the group financial statements, which is 100% of the parent plus 100% of the subsidiary on a line-by-line basis, plus any group adjustments. Then that's the endpoint. So now we know the endpoint, we'll need to know the starting point. Okay, so the starting point, typically in the real world, the starting point is going to be 100% of the trial balance of the parent, 100% of the trial balance of the subsidiary at the end of the current financial year. Okay, so that is basically what it will be. Then, in order to move from the starting point to the end point, we'll have to process certain adjustments, and these are the pro forma journal entries. So that's basically what we are trying to do. The only important aspect that we'll have to consider is in which period does it relate to. Is it at acquisition? Is it since acquisition, or is it current year? So that's what the thinking behind it. Okay, so yeah, so that is basically what we do. So we just started off to say, in order to process the journal entries as per the document attached, Fodgen would need to perform the following: obtain the trial balance of Big Ranch at 31 October, add it to the trial balance of Fodgen at 31 October, okay, on a line-by-line basis. This provides the correct starting point required to make the necessary pro forma journal entries that will end up with the correct consolidated acts, okay? So now we can review the actual journal entries, okay? So now we can say review of specific entries. Okay. So review of specific entries, okay? So journal one to journal, I think it was 4. Let me just go check quickly. So journal 1 to journal 4. Okay. So what's important to take note over here, the account, the journal, the journal entry line item called line item account retained earnings and earnings at acquisition should be goodwill instead. Okay, should be goodwill instead. Okay, so if the process of processing the journal entries like that, then it should be goodwill instead. You could also ask him to remember, we're just reviewing the journal entries, right? So any journal entry that is written earnings at acquisition should actually be goodwill. Okay. Okay. So what you say, if the journal entries are prepared on a um, on an item by item basis, okay, then the journal entries the journal entries line item account retained earnings should be goodwill instead. Okay, so that's what we're just saying over there. Now we can go to journal entry number 1. So all I'm saying over here, when we prepare journal entries on an item by item basis, the other side is always goodwill. It's not retained earnings. Okay, so that's important. Now we can say journal entry number 1. So journal entry number 1, the provision for restructuring, is not a valid journal entry. Okay, is not a valid journal entry. Why not? This is because the restructuring costs are future related costs. Okay, so that is not a valid entry. Okay, so journal entry number two. Which journal entry? It is the customer relationships. Okay, the customer relationships is correctly recognized as an intangible asset. Okay. However, the amount of 4 million may not be accurate. Okay. The amount should be the fair value of the amount should be the fair value of the customer relationships at 1 July 2022, and not merely what the, not merely the amount that the board places on it. Okay, so remember, the fair value should be the fair value in terms of IFRS 13, which is what market participants would place on it. Okay, so just take note of that. Okay, so journal entry number 3. Okay, so journal entry number 3, the workforce journal. Intangible assets relating to the workforce is not a valid journal entry. Okay, it's not a valid journal entry. Intangible assets relating to the workforce is not a valid journal entry. So that is what we would state. So the intangible assets relating to the workforce is not a valid journal entry. Why? Um, uh, the workforce cannot be recognized as an asset as people cannot be controlled. Okay, so it does not meet the definition in terms of controlling. Okay, so therefore that one is out. Okay, so that's important to take note. So we can't place a value on the workforce. Okay, then the provision for legal claim, journal entry 4. Okay, the provision for legal claim is correctly recognized as a provision. However, the amount as null is not appropriate. Okay. The amount should be the fair value of the claim, at 1 July 2022. Okay. We should seek legal advice. Okay, so that is to determine whether we should seek legal advice to determine the fair value. if um, if there is a high probability of success. Okay, so that is basically what we're just saying. Now we come to journal entry 5. So journal entry 5 is largely correct. The one aspect over here is the retained earnings and then the investment in big ranch. Okay, so journal entry number 5. Okay, the stated capital is correctly eliminated. Okay, um, assuming, okay, correctly eliminated only if the only if the trial balance of Big Ranch at 31 October 2022 is um, accounted for. Okay, so as mentioned above. Okay, so remember, you can't eliminate stated capital if it's not in our starting point. Okay, what is there to eliminate if it's not in our starting point? Okay, so the stated capital is correctly eliminated only if the trial balance of Big Ranch at 31 October 2022 is accounted for, as mentioned above. So you brought it on. So if we don't bring that on, there's nothing to remove. Okay, so that's important to take note. Okay, okay. So I'm assuming the trial balance of Big Ranch is included in the starting point. Okay, then the retained earnings is correctly eliminated. Okay, however, the amount is incorrect. Okay, the amount to be eliminated, should be the retained earnings at acquisition. Whatever the amount was, 4459. I think it was 4459. Okay, so that is basically what we would say. Fine. Okay. Okay, goodwill would be the correct balancing figure as made mention um, okay, so be the correct balancing figure. Okay, they will say same as for journals 1 to 4. Okay, so that's important that note. We just wanted to know that. Then we need to state over here the consideration is incorrect. Okay. Okay, the cost of the investment. The cost of the investment is correctly eliminated. Okay. Okay. But however, the price is wrong. Okay, the amount is incorrect. Okay, so however, the amount is incorrect. Okay, the amount correctly includes the 14.1 million. Okay, but incorrectly includes the 400k legal costs, and incorrectly excludes the fair value of the contingent consideration. Okay, so that is basically what we will have to say, contingent consideration. Okay, so that's basically what we discussed in the previous video. Okay, so just basically, I'm just taking you through the explanations as you're writing it. What you will come to learn is there's two aspects you have to learn in this thing. It's basically the technical stuff, knowing it in your head, and explanation and so forth. And then it's the next thing is how you present that answer to the person you're responding to. That'll come with some practice. Okay, so for me, there's not necessarily the perfect way of responding, but as we work through certain stuff, we can you can figure out how you'd like to respond, how you'd like to set it up, your layout. This is basically how I would most likely have done it. Okay, so that is basically the those journals over there. Um, now we will discuss some further consideration. Okay, further considerations relating to the journals. Okay, so over here, so what is important to take note is that there's no non-controlling interest, and that's correct. Okay, so there is um, there is correctly no non-controlling interest recognized. Okay, so they correctly did not recognize non-controlling interest as we acquired a 100% stake. Okay, as we acquired 100% of the equity. Okay, so that's the important aspect. Now, the other thing that we did not do is there's two things we did not do. Okay, however, um, the journal entries at acquisition does not include any fair value adjustments relating to the assets and liabilities at acquisition. Okay, so so we'll need to bring that in. Okay, so the the so we have to bring that in. Okay, so the journal entries at acquisition does not include any fair value adjustments relating to the assets and liabilities at acquisition. Okay, so that's important. We discussed that above as well. Also, the the earnings of current year has not been accounted for. Okay, the earnings of the current year, and we want to make it clear, which is 2022 to 31 October 2022. Okay, so the earnings of the current year are, I think it was 210K, have not been accounted for. Okay, but now here's the important aspect. So we will say, however, if the starting point includes the trial balance of, if the starting point includes the trial balance of Big Ranch, okay, then there is no need to account for the 210,000. Okay, the only adjustment that would be required, the only journal entries that would be required are journal entries relating a value adjustments at acquisition. So for example, um, if furniture and fittings furniture and fittings um, um, has a fair value adjustment, then if furniture and fittings has a fair value adjustment, then there would be a depreciation pro forma. Okay, pro forma. Okay, um, the there is going to be a difference on the right of use assets. Okay, there will be adjustments to lease to the right of use asset, to the right of use asset and lease liability. Okay, so the interest would be interest expense would be different, as well as the depreciation on the right of use asset would be different. So that's important. Um, any fair value adjustment adjustments um, between the acquisition date and financial year end, financial year end relating to the contingent liability, the contingent consideration and contingent liability. Okay, that was recognized as a liability. Okay, so basically that is going to be a definite. Okay, so that is basically the review of the journal entries. So what we did a review of the journal entries. We also did a completeness check. Okay, so this is basically the completeness of the journal entries. Um, what we also did some commentary above. Okay, so that is basically what this question is all about. It was literally knowing consolidations, but then answering it in the context of this scenario. Okay, so if you have any questions, then we are free to have it in our one-on-one sessions. Thanks. Bye bye.